everyone, thank you for joining us for this week's Teen Crumpets. I'm Gloria S. Crump, the Queen of Real Estate with the Coast Leaders Realty Group, and today our special guest is Brian Lehmann with Rapid Mortgage Company out of Foley, Alabama. Thank you for joining us.
Thank you for having me.
Yes, and so not only are you licensed in Alabama, you're also licensed to do mortgages in 2 other states. What are those?
Louisiana and Florida.
Okay, great. Well, and I'm also licensed in Florida as well. So with the name Rapid Mortgage Company, how quick have you done a mortgage and gotten the borrower approved?
The quickest has been 5 days.
So that's pretty rapid.
Yes.
Yeah. But typically now it all depends on how quick the borrower gets everything to you.
Yes.
So what on average do you usually see if the person's pretty quick on, when you call in and say, hey, we need this, or what is this cost on your, statements and things of that nature? What is your average turnaround time?
Typically, if a person, say we go to them at 10 o'clock this morning, and they can have it back to me by 2 o'clock in the afternoon, then I'll re-upload it to the underwriter. At that point, the way things are working in the marketplace, they can have it out of underwriting within like 24 hours.
Oh, wow. So it's pretty quick.
Yes.
So, well, you got to live up to your name.
Yes, right.
So, now one thing that we were talking earlier is that there are certain things that other banks might charge, when it comes to the interest and stuff, and Rapid doesn't do that. So that's an overlay.
Correct.
All right. And some people watching might not know what that is. So do you mind explaining what an overlay is?
Basically, what an overlay is normally is when somebody has we have findings come in from Freddie or Fannie, and they say, we want these items. That's exactly what we'll ask you for, where a lot of the banks will come back in and say, or other lending institutions will come back and ask for more on top of it, just to double cover. And again, typically if the government is good with it, we're good with it. Now also, we don't charge any excess fees. Pretty much if it's a fee required, we will do it. And that's kind of how we set everything up.
Yeah, so y'all don't charge like some of these additional fees that other...
Correct.
Yeah, and that's something good for, borrowers to know, because they might not realize they might think that's just a common fee where they could be saving money by going with y'all.
Correct.
So, and now one good thing about it is that some borrowers, we've gone through some little tough times and some people's credit scores might have taken a hit, and one thing about being with, going to a lender that's, can educate them on what they could do to possibly increase their credit scores, and you actually are able to coach them.
Yes.
And so what are some things that you see that are just generic that they can do that, because to help their credit scores, pretty quick, simple fixes?
Well, one of the things is no matter what, if you can keep your credit card debt below 50%, and that's total usage for all cards. Also, if you can get it down to a third of the credit limit, that really helps. And paid off, if you can initially start, if you can pay your card off every month and keep it paid off every month over time, that'll actually build your score up quicker than anything.
Yeah, oh yeah, for sure. And one thing that we were talking about, the number of lenders in this state and the percentage of those lenders that have actually written the loans. I think this is pretty interesting for borrowers to know that when they're talking to lenders, they, just have you even done a loan, so what is that percentage that you were telling me about?
According to one of the state meetings, right now there are 15,000, as of November, 15,000 mortgage lenders in the state of Alabama, 3,000 of which had written at least one mortgage.
Yeah, that's wild. So I think that should be a very good question to ask. Say, have you even done a loan?
Good point.
Because only 20% have. So, and then one thing is, you hear a lot of people about go ahead and buy now, and then you can refinance later. Well, there is a certain time frame based on that, and will you explain what that is? This is actually really important for people, especially this year. We're expecting to see the interest rates drop some.
Yes, what it is, if you try to refinance your house in less than 6 months, that actually causes the wheels to fall off for most lenders, and that actually, what they want you to do is hold it at least 6 months. If you do it less than 6 months, you're looking at clawback, and that is bad for the lender and for their representative you work with. It's like in my case, we try to work with folks, and if they said, I've got to refinance for whatever reason, we'll help them and actually defray a lot of that for them if they'll actually come back to us and let us refinance it for them.
Oh, really? So that can also help. So, but a clawback is where they have
Yes.
sometimes the lender has to potentially
Yes, as an
pay
example.
the difference.
Say the borrower sees I've had all these fees or whatnot.
Mhm.
Well, what happens is the lender and the loan officer is responsible for those fees if they're not covered
Yeah.
within 6 months. So that's why they want you to hold it for at least 6 months, and that's why lenders are very specific, especially with somebody who's coming down and like, I'm buying a house in Gulf Shores,
Mhm.
but I'm going to sell a house in Indiana. Well, they'll tell you, unless you're planning on, you can write that loan down.
Yeah.
And that's one of the things they don't get. Say you have a $500,000 house in Gulf Shores,
Mhm.
and you have $700,000 you just brought in from Indiana. If you will hold it and pay it down to like $20,000,
Uh-huh.
and then at the end of 6 months you can pay the 20 grand off, and nobody's hurt.
Oh, wow, yeah.
And I know that's one of those things folks don't think about, but it's very damaging to the lender and their loan officer.
So even if someone were to just pay off the loan within 6 months, it could still come back to that lender and they have to pay.
Yes, all
stuff.
the fees back.
Oh, wow.
And literally, it can be one of those where they can go back one day early,
Mm-hmm.
and that one day costs the lender all of it.
Oh, really?
So that's why lenders try to work with you and try to help you do all these things, because they don't want to get beat up.
Oh, no, not at all. So it's not just the refinance, because I do have a lot of people who they don't want to make an offer contingent upon their home selling somewhere, because they know that can kind of hurt their chances of getting that particular house that they want, because sellers have their goals of why they need to sell, and sometimes the time frames don't work out very well. So I've had people who say, okay, as soon as I sell my house, wherever it may be, they go and they want to pay off their new mortgage.
Yes.
And sometimes it does fall within 6 months if that's what they want to do, but that also kicks in what y'all calls a clawback.
Yes.
Not just refinance, but also when someone pays off a full mortgage.
Yes.
Interesting. Did not know that.
And that
I'm
can be
learning.
thousands of dollars.
Yeah, it definitely can. It definitely can. So this year, there's been a lot of buzz about we're going to see interest rates drop.
Mm-hmm.
Hopefully, fingers crossed. And so they're saying that there should be potentially 3 adjustments for the prime lending for the interest rates. Why do you think that might be the case? And we're not going to hold you to it. It's just opinions. These are opinions. I have my opinions, but this isn't my show. Well, it's my show, but you're the guest.
I appreciate it. Thank you so
Yes.
much. But part of what's going on is one of the biggest things is the politicians behind it want to get the most bang for their buck.
Mm-hmm.
And the closer they can do it to the election, obviously, the more it makes them look good. Now, some people will argue that point, but if you look, the people who are responsible for it are still politicians at the end of the day. That's number one. Number two, there's thought that the inflationary forces have started retreating a little bit. Now, there are another group that say they're not, but whatever. The people who are in control are the ones saying it looks like it is, and that's why they're willing to pull it off.
Mm-hmm.
They're keeping it intact until about June before they'll start lowering it, because in June, that again gives you the first effect, plus it gives you time for the inflation to settle down some more.
Yeah.
So hopefully they'll be right.
Yeah, I hope so. I definitely do. And one thing that I found that was interesting is that you always hear if you put 20% down, you do not have PMI.
Right.
But obviously a lot of people are not financially able to do that, so they hope to, that the PMI will drop off on its own. Sometimes you have to submit an appraisal, but it's not when your loan gets to the 80% loan to value. It's actually a different percentage, and I found this out and I thought this was interesting. What is that percentage?
The actual percent is 78%.
Yeah. So, if it's a large loan amount, 2% can make, a
Yes.
big difference. But I just always thought is right when your loan got to the 80%, it just falls off, so to speak, but it's actually 78%.
That's correct.
Yeah, so that's interesting. Y'all might not know if I didn't. So I thought that was very knowledgeable to know. And short sales, you also do loans over in the Mobile area.
Yes.
And stuff. And so, but you're starting to see kind of an increase in the short sale market.
Yes. What you're seeing is more people who are being affected with their income, who were buying houses with overtime income. Because of what's happened in the economy, they've lost a lot of that overtime income, so they're not able to afford the houses easily, so they're trying to sell. Well, if they bought it in the last year or 2 years, they're probably going to sell it with a loss because they had extra costs that went into it.
Yeah.
Because of that, they're looking at a short sale. which is all well and good, but that it's actually just starting to ramp up more, and you will see more of that out there.
Yeah, I have a feeling we'll see it. So hopefully not, because you never want to see people in distress situations.
Yes.
But sometimes it's just inevitable. But we were talking earlier about right now it is a little easier to get loans, and why is that you see?
A lot of it has to do with the fact that the interest rates did go up.
Mm-hmm.
As the interest rates go up, that gives the investors, meaning the banks and such,
Mm-hmm.
more money to put out there. That means they can cover more of their risk.
Yeah.
When it's real super low interest, there is nothing to cover risk.
Yeah.
That's why they were pushing folks away.
Yes.
But go ahead.
And there's a lot more buyers wanting to purchase, so they were just getting inundated with people wanting to purchase, and they were having to get stricter because the interest rates were so low.
Yes.
And so now with it high, they're like, hey, we might do a little exception here or there to
Good point.
make up for all those low times of low interest rates and everything. And one thing is that, it used to be a max of 5 loans that people could have when, especially down here in this market, we see a lot of people who buy investment properties and second homes. And so, it's, obviously they buy their primary residence here, but mainly more investors.
Mm-hmm.
So it used to be a 5 max of loans, and now that has increased.
Right. Now, what you're seeing is a buyer can buy as many as 10 loans
Mm-hmm.
and do it as a conventional loan. The caveat on that is some of the lenders themselves are still capping it at 5, but that's
Yeah.
individual banks and whatnot.
Oh yeah, but it is a 10 max
Right.
of the loans, and obviously you have to qualify and things of that nature.
Yes.
But no, I thought that was pretty interesting too. So now there are certain types of loans that Rapid can do,
Mm-hmm.
and one of them is that I've run into situations where people ask about construction loans, and I have run across where some lenders do not handle that, but y'all do. So,
Yes.
and that's also including the lot, which I thought that was really good to know too.
Yes.
And so if someone already owns the lot, can they refinance that lot and then tie in the construction part of it as well?
Yes, they can. As a matter of fact, what the lender wants you to do, or what we want you to do, is to take the lot and actually bring it in to our loan.
Mm-hmm.
And that way, both the construction and the lot itself are all in one package. And that
Yeah.
that actually reduces some of the risk.
I was about to say for the borrower too.
Yes.
Yeah. So, and one other thing is too, people think mobile homes,
Mhm.
but it's all about location. I mean, there are mobile homes out here that sell for well over $250,000, and y'all actually finance double wides.
Yes.
Yeah, so I think that's actually great to know.
Yeah, and it's funny because they are looked at basically as a standard home. I mean, there are a few extra rules on it, but those rules have to do with just anchoring the property down, taking the tongue off the trailer, things like that.
Yeah, because just our market, if it's waterfront mobile home, my goodness. But y'all also do non-qualified mortgages as well. And so for people who aren't real sure what a non-QM is, non-qualified, do you mind explaining just a couple of those that would fall in line?
Sure.
Okay.
As an example, you would have somebody with a bank statement loan. Say you own your business, and in that business you're depositing lots of funds, but you're the type that likes to write off every penny you can because you don't want to pay taxes at the end of the year because it's a personal thing.
Yeah.
Well, with a bank statement loan, we take your bank statements and we submit them to an underwriter. They look at it and they are the ones that determine, okay, you make X number of dollars a year, and but based on that, this is what you can afford to purchase. Now, another similar type would be a DSCR loan, where someone is buying, say, a condo, and the condo has already got a track history of being rented out. But using that track history, they can say, okay, with that, it does hit a ratio of 1, which means you're making say easy numbers. You're making $1,000 a month in rent, and your monthly note is $1,000 a month. As long as it's 1 for 1. It typically will allow it to go through. They prefer it to actually be, $1,100 to $1,000.
Oh, for sure. A little bit more, just in case.
Yes.
Just in case. And then let's see. Oh, and this is another thing about people with student loans. Obviously there's still people out there with student loans. And then will you explain that? Because there's some, for people who are maybe not even having to pay it right now, but will you explain the whole payback and the percentage and how y'all issue that?
Yes.
Okay.
What happens if you have student loans outstanding, even if they're deferred? People think if it's deferred, it should not count against me, and actually it does. The Fannie, Freddie, FHA, all the rest of them force us to look at it this way. If you've got easy numbers, $100,000 worth of loan, we're supposed to give you $1,000, meaning 1%, as a cost every month. Now, that is pretty much the standard. Now, the rule has opened up a little bit where we can do it 0.5% on other types of loans. FHA is still pretty weird about the 1%, but some of the others. So instead of $1,000 a month cost, we can give it to you at $500 a month cost, which is much better.
Oh yeah. Well, you are able to do the different. You can buy $500 goes to a house payment. You can get a much larger home, and
yes,
it could be the difference between your dream home and your not dream home. And so now, what are there certain factors that play in, like person's income and interest? Credit score that would make it to be where they could do the 0.5%. Are there certain factors, or is it just like Rapid Mortgage is able to do the 0.5%?
There are certain factors, yes. If you're going to do one of these loans, depending on the type of loan it is, they normally want you to have a little bit higher score, but for obvious reasons. For a conventional, you're probably going to be looking 620. Actually, you're better if you're at 680. At 680, everything opens up into your world, and you get a lot better opportunities. Where FHA, USDA, and those type, they're pretty much okay with 620. But again, for the benefit of the buyer, it's always better the higher the better.
Oh, for sure. Yeah, and you get a little bit better interest rate.
Yes.
They say. And there was one other thing I would like to mention or talk about real quick that I just thought about. Oh goodness gracious. The manual underwriters. So, because you mentioned about 620, sometimes you're like, okay, you really want to be a little higher. Now, with the manual underwriting, it's never a good thing, like you were saying. You never want to do manual underwriting. But is that under 680 or is that under 620 if your credit score?
That's a very good question. Typically, it's if you're under 620 on an FHA or a USDA or one of those, but it does get much more difficult. The only exceptions that will work is if somebody's had, like, say you went out and you missed a credit card payment for whatever reason. You were in the hospital,
it's just something happened.
Well, in that case, then the underwriter can look at it and say, okay, we can accept this as a risk and move on. But a lot of times what you find is somebody's under that, they'll have other issues also, and that'll almost certainly kill the deal. That's why we want to look at it and actually look at it very hard.
Yes.
And of course, obviously, we're going to try to coach them up and get their score up over 620 no matter what.
Yeah. But the thing is that y'all still can do the manual underwriting and like kind of ask questions and things of that nature. So, well, that's great. Well, I feel like we've covered a lot of information. I know I learned a lot. So, is there anything else you want to discuss on?
The biggest thing for folks to know is people are always afraid when they approach a lender. Because especially they're afraid because they're going to ask a lot of questions, but they have to. It's part of their job. It's never used against you. But just be open. The more open you are in the beginning, the better it is for you through the process.
Oh yeah, for sure. Yeah, because if there's hurdles, y'all can tackle it early on, and not towards the very end. And because when buyers go under contract, it costs money with inspections and appraisals and. So if they are, and termite inspectors, so if they are upfront and honest, and that way, they can save close to $1,000 if they need to hold off a little longer to build up their credit or anything of that nature, or they know something's lurking in in their financial statements that they need to hold off. So
yes,
but no, I definitely think being upfront and honest, and with the realtor too. So just not just the lender, but us as well. But, well, good. Well, I really appreciate you taking the time, and we'll have Brian's contact information at the end of the video, and hopefully you'll give him a call, and you'll, I appreciate you working with us.
Thank you very much. I've enjoyed being you and your team.
Thank you so much. Have a great day.